Equity Bank has reported a 17% rise in first half profits to 9 billion Kenyan shillings, attributed mainly to a fall in costs. Total income grew 15% to 20 billion shillings. And joining us now to unpack the numbers is James Mwangi, the Chief Executive of Equity Bank. James, there's lots going on in the banking scene in Kenya, and we're certainly going to be talking about some of those developments in a moment. But the interesting part of the numbers to come out today was the fact that your cost-to-income ratio is now down to 49%. Now, there aren't many banks in the world who are close to your kind of level. I guess that does support your view or your statement that you put out in the results today, that a big reason for your profitability improvement is this cutting of costs.
It is true that the cost structure and the efficiency of the bank is a major driver. Worldwide efficiency in utilization of capital, we are ranked number 12 best bank in the world. And in terms of efficiency in utilization of assets, we are ranked the 4th best bank in the world. And that is available in the Banker magazine for the top 1,000 banks. And essentially what we have done is over the last 3 years, we have been focused on structuring our balance sheet, both assets and liabilities, to align them appropriately to optimize earning assets and ensure a portfolio and a mix that optimizes return. But at the same time, we then have looked at the delivery channels and said, how can we move our 8.3 million customers to a self-service menu. And we now have nearly 3 million customers accessing the bank from their mobile phones. And that really reduces enormous cost structure, both in terms of infrastructure and in terms of staff cost. But the biggest impact is coming from the agents.
Yeah, James, that mobile phone penetration is world class. And the question I ask on that is the one that I asked to your peer at KCB, was why do you not export that? Export the intellectual property that you have. We know that Kenya is ahead of any other African country when it comes to the internet and mobile generally. Why don't you use that to perhaps expand to other parts outside of just East Africa?
I think the biggest challenge in exporting the model is regulation. You must win the confidence of the regulators. They must be willing to approve mobile banking as a delivery channel. We now have got Rwanda as a country approved, and we have already launched that. And the interface with the telecoms is proving to be very impactful on the model. But in addition to mobile, I think the agency is the ultimate thing, because what we have seen is agency model provides a win-win situation where customers are able to access banking from their doorsteps, of their places of work. And at the same time, we save them the cost of accessing the bank. The barriers to banking access is also removed. And that has really helped to improve. And I would be very optimistic that in the next 2 years, we shall have a cost-income ratio of 45%.
Wow, that's incredible. James, just to look at the competitive situation within Kenya, the recent transaction between Absa and Barclays, where Absa will now become Barclays Africa and no doubt be investing a bit more time and effort in its Kenyan subsidiary. Are you expecting that this could shake things up?
The Kenyan market is going to see a very competitive environment going forward. We've seen the South African banks. So far we have 3. The Nigerian banks, so far we have 4. And this combines with the 40+ banks, Kenyan banks. And this is likely to increase competition very significantly.
But if
We're
we talk competition,
now to see
if we talk competition, the question that keeps coming up internally is why banks in Kenya have not reduced their average lending rates to the same degree that the central bank has been reducing its lending rates. What is the story there? What's the rational answer to that?
I think the story is the structure of the Kenyan economy. You'll find a lot that today we are still talking about treasury bills are at 12%. So you say that is the free rate cost of lending, or that is the base of lending. So when banks start lending at 16, so you're saying the margin that they are making is only 4%. And this has to do with getting it right with the economy. A lot of effort has been done, and we are seeing the microeconomic environment stabilizing, shaping, and moving towards the right direction. But that volatility is what really causes these challenges.
Thank you for clarifying that one. The Chinese influence in Kenya is significant, but the innovative approach that you've taken to opening a branch for Chinese people, staffed by Chinese people under the Equity Bank banner is unusual. Tell us about it.
What we have realized is that the infrastructure development in this country to a great extent is being done by Chinese companies, whether it is roads, whether it's bridges, airports and ports. And essentially, we wanted to promote supply chain that includes the Chinese companies and local business people, the SMEs. And we couldn't be able to do that integration without embracing the Chinese companies. So we felt the best way of doing it is forge an alliance, one with the China Development Bank, so that we could really have a referral process. At the same time, create a branch that we seek to understand and make it easy for them to speak in their language, get bankers from China who are able to analyze such that the process becomes easy. And that has been very helpful to the bank. What has amazed us is that the risk factor on these Chinese companies is low, because they fund up to 60% of the business. When they come to you, they will have already financed 60% of the project. So it's more of bridging from the traditional lending that we talk about in Kenya.
And they also save a lot more than we Africans do.
That is true. You look at the balances of the employees of the Chinese companies, which majority of them we are banking. The culture, or those of them, is that they maintain very healthy branches. They want to make money before going home. They don't assume they have come here to consume. Their consumption propensity seems to be much, much lower than propensity to consume.
And the deposit base, no doubt, helps you to fund more cheaply. But give us an understanding of the size of the deposit base in the Chinese specialized branch, and how long it would take for one of your other branches to get to the same level.
What we've been amazed is that the Yaya Center branch that we opened for them, and Lavington branch, within 6 months, these branches has hit 2 billion shillings. We are talking about $30 million in terms of savings. So you find the culture is very, very different. And then it is these savings that are availed to the corporations that are borrowing. So it's a self-funding program